GE Aerospace stock is taking off right now, and investors are asking one thing: is this just hype, or is this a long-term money machine? Because this move isn't random. We're seeing strong earnings, a record backlog, Wall Street upgrades, and massive global demand all hitting at the same time. So let's break down what's actually happening and what it means for your money. First, the biggest driver: demand for aircraft engines is exploding. Airlines are flying more, new planes are being delivered. And every single one of those planes needs engines and, more importantly, decades of maintenance. That maintenance business is where GE makes the real money. They don't just sell an engine once, they get paid to service it for 20 to 30 years. That's high margin recurring revenue. And right now, GE has a backlog of about $190 billion. That's not just orders, that's future cash flow already locked in. Now pay attention to this. When investors see predictable revenue for years, they're willing to pay a premium for the stock. That's one of the biggest reasons shares are moving higher. Next, earnings. GE didn't just report a good quarter. They beat expectations on both profit and revenue. That tells Wall Street the turnaround is real. Margins are expanding, cash flow is improving, and guidance for the next year is strong. This surprised Wall Street because the most profitable part of the business, the aftermarket service segment, is growing faster than expected, and that's the part that compounds over time. Now let's talk about the engines themselves. GE powers a huge portion of the world's commercial aircraft with its LEAP, GEX, and GE9X engines. Every time Boeing or Airbus delivers a jet with a GE engine, that's a long-term service contract. So this isn't a one-time sale, it's a 20-year revenue stream. That's why big funds love this business model. Now let's zoom out globally. GE is expanding heavily in Asia, which is the fastest growing aviation market in the world. They're investing hundreds of millions into new repair facilities using automation and AI to increase efficiency. More planes in Asia means more engines. More engines means more servicing. More servicing means higher profit margins. And then there's India, a massive engine deal tied to fleet expansion. That gives GE exposure to one of the fastest growing air travel markets on the planet. Investors see this and think, this is not just one good year. This is a multi-year growth story. Now add another bullish factor: share buybacks. GE has been buying back billions of dollars of its own stock. That reduces the number of shares in the market, which increases earnings per share and supports the stock price. They're also paying dividends. So you've got growth, cash flow, buybacks, and dividends all at once. That's exactly what institutional investors look for. And when institutions buy, the trend usually continues. Analysts are also raising price targets. Higher targets bring in more funds, more ETFs, and more momentum buyers. That creates steady upward pressure instead of a one-day spike. But here's the part retail investors need to understand. The stock is not cheap. GE is trading at a premium compared to other industrial and aerospace companies. That means expectations are very high. So if growth slows, if earnings miss, or if airline demand weakens, the stock could pull back even if the long-term story is still strong. Here's what could happen next. We could see short-term volatility while the company grows into its valuation. That's normal for high-quality growth stocks. Smart investors right now are watching three things: aftermarket revenue growth, new engine deliveries, and free cash flow. If those keep rising, the stock likely keeps trending higher. If they slow down, expect a correction, but the big picture is clear. GE has transformed into a focused aerospace powerhouse with recurring revenue and global demand. That's why Wall Street is bullish. So, the real question is this: is GE Aerospace a long-term compounder you buy on dips, or is the stock already priced for perfection? Comment below, buy the dip or too expensive, and tell me which stock you want next.